Welcome to the What to Watch video update. This is the last video that I do each week where I pick out the charts that I'm really focused on for right now because we're trying to answer the question, this rotation that we're seeing into small caps, if that continues, is this going to cause more problems for the S&P 500? As always, we have some positive things and some negative things that we can look at. Before I start, I do have a thing called the SPX investing program. It's free right now. I'm probably going to lock it down in August. So feel free to check that out. I post additional things that I don't post on YouTube or Rumble. And when I lock it down, I'm going to be posting a lot more that's not necessarily for public consumption. It's more for members to look at. If you want to go to the program, there's a link in the description below this video. If you want to find out more about the program, there's another link that takes you to a playlist on YouTube, and you can go through some videos. This video that I'm doing right now, I consider it to be a supplemental video, and all the other videos that I do that are around the outside, these tie into the real focal point of my analysis and commentary, which is the daily video. So if you really want to follow as things are unfolding, please tune in to the daily videos. Now, if you're a member in the program, you get access to that video right when it's uploaded. If you're not in the program, it becomes a public video right when the market closes for that day. So if you don't mind waiting, that's fine. If you want to have access to it, and it's really designed for that particular day. For example, the video for Monday, that's to analyze what happens during Monday's session. Then right when Monday closes, that's when it becomes publicly available. So if you like to have a little bit of a heads up as to what we're analyzing for right now, feel free to get early access to the daily videos. First of all, I'll go through the things that are looking positive right now, and we have some things that are really looking positive, and we also have some things that are really looking negative. And as always, there's some things that you can see both ways. It might be positive on one hand and negative on the other hand, or negative on one hand and positive on the other hand. So we kind of have to look at this a couple of different ways. The first area that is still looking positive for right now is the advanced decline line for the S&P. This has been holding up fairly well. We haven't broken out yet above this previous high, but we're still going up for the most part, and we're well above the moving average based on price. Now, we're going up less when you look at volume, and that's been a bit of a concern. A week or two ago, I was pointing out that it seemed like volume was leading price higher, and then that's what ended up helping the market to go up. Right now, when we're going up, we're seeing volume going up less. And in some instances, we're seeing price going up and volume actually going down. So that's just a little warning sign that we want to be aware of. But when you take both of these together, they're still looking positive, but we also have a warning sign when we're looking at volume. Another internal measure that we look at, new highs minus the new lows, they are falling off, and that's causing our 5-day moving average to go down and our 10-day moving average to go down. But still, we're seeing a lot more green than we are red at this time. So even though it's showing some weakness, it's still looking fairly positive overall. We're also looking okay when we look at the advanced decline ratio, both in the short term, that's the blue line, and in the more intermediate term, that's the red line. And they're above zero and going up. So that is positive. We're also still dealing with the 50-period moving average. It looked like this was going to be negative because on Thursday, we actually dropped below and closed below the 50-period moving average. Now, I have two moving averages on here. One is a simple moving average where all 50 periods are the same. The other one is an exponential moving average where it's more weighted closer to current prices. We're right about on both right now, and we were able to get above that. So for right now, the intermediate term trend, which is what I use to define, I use the 50-period moving average for that. We're above this moving average, and this support level is currently holding up for right now. If we lose that and really start to drop, then we're going to start watching the 100-period moving averages, which is the next chart, and we're still well above this. We also have some pivot points in here that may act as support, but if we continue to fall, we will watch this chart as well. But for right now, it's positive since price is above both of these lines. Then here's all the moving averages together. Now in the short term, we're negative because we're below the 20-period moving averages. We're still hanging on to being positive in the intermediate term with the 50-period moving averages. And as I said earlier, the next stop that I follow anyway would be the 100-period moving averages, and then down below are the 200-period moving averages. The takeaway, at least here in the longer term with the 100s and 200s, is that they're still going up and price is still above them. So that means that the longer version of the intermediate term and the long term are still positive. We're seeing a bit of a mixed picture here with the Swenlin trading oscillator. Based on price, we've crossed back above zero after we were negative. We turned up based on volume, but we're still below zero. So here we're seeing a bit of a negative divergence when you compare price with volume. Also, the moving averages are showing a bit of an improvement. We had the nice little bump up on Friday, and so we're turning back up with the 20, 50, and 200-period moving averages. And these are measured just on the S&P itself. This is another way of looking at the advanced decline line for the S&P. This is a cumulative measure based on price where it's going up, but look at how much we fell based on volume, and we didn't go up all that much based on volume down here. So that's another little bit of a concern. Now, one thing to keep in mind is the big stocks, the Magnificent Seven, the NVIDIAs, the Googles, the Apples, and that, they are not only in the NASDAQ 100, they're also in the S&P 500. And that's where a lot of the volume comes from. And if we're seeing some weakness with the really big mega caps, that's a lot of volume that's getting taken out. And if now, on the other hand, that can be positive because it's not being taken out of the market. It's being taken out of one place and put into a different place, as you'll see when we look at some of the broad market charts here. But it just means that there's a little bit of an imbalance when we look at volume. We have to keep that in mind. But at the same time, we have to respect what we're seeing here in that volume seems to be weaker than price right now, even though they both ticked up on Friday. Now, this is also positive for the time being. Even though it declined, this is the bullish percent index, and this measures point and figure buy or sell signals inside of the S&P 500. Now, the S&P has been going down, and while it's been going down, the bullish percent index has either been going up or just declining slightly. Because it's the big stocks that are really pulling the index down, the rest of the S&P 500 is still holding up fairly well, and so that is a positive outlook on this. We did decline, that's slightly negative, but we're still above 50, so that is also positive. We look at the new highs minus the new lows for the S&P 500 and then take a 50-period exponential moving average of that. We're still positive since we're above zero. And we were going up as the S&P was going up. Now we're starting to roll over a bit. It's really hard to see. And we don't know if this is going to develop into anything more. But right now, this is positive on one hand. Since it's ticking down, that's slightly negative. We look at a 10-day average of the S&P 500 highs minus the lows, and we're getting a really solid reading here. Now we're coming down. We're just a little bit above this green line. But for a lot of 2024, we were above this green line, which was suggesting good momentum. And even though we have been falling with the S&P, the fact that this is still giving us a pretty high reading means that the S&P, when taken together and over a longer period of time, over 10 periods, this is still holding up quite well. Then we look at those stocks inside the S&P that are above their 20-period moving averages. We had been declining. We're still above 50. That's positive. And then we went up on Friday. That's also positive. Here's a study that we've been looking at. Now, the study originally started when we went down in April and hit that really low reading here. And then not too long after that, we shot up out of there. And then you can see what the S&P did after that. And it was going up. We're kind of waiting to see, is that past now? Did we get enough of an up run for this to still be valid? We were looking pretty solid here, but since we've been pulling back with the S&P, this has been coming down, but it's also been holding up fairly well, meaning that the rest of the stocks in the S&P are still hanging in there. We're also still looking okay with those stocks above their 50-period moving average. We're above 50, that's positive, and we went up on Friday. We're also looking positive with those stocks above their 100-period moving average and those stocks above their 200-period moving average. Then we look at the broad market here. Here's just a daily score for the new highs minus the new lows. That's the black line that you see here. When it's above zero, that's positive. When it's below zero, that's negative. We are still above zero. Now, what I do is I plot a 50-period moving average on here as well, and that's longer term to kind of smooth things out. And this is also still going up. So the broader market is still hanging in there pretty well. This is another broad market measure. We take a 5-period moving average of the highs minus the lows, and we're still above zero here as well. And this is actually quite encouraging. The NYSE bullish percent index, it actually went up this week as the S&P has been going down. That also suggests that we're seeing more broad market participation to the upside, even though we're seeing weakness in the NASDAQ 100 and in the S&P 500. Then we look at another broad market measure, the Wilshire 5000. We came right down to the 50-day moving average. We closed a little bit below it on Thursday. We were able to get back above it on Friday. So this is kind of the line in the sand right now that the market is trying to battle through. Are we going to be able to keep bouncing up off of this, or are we going to end up falling down below it? That's the question we're asking. And we look at the advanced decline line studies, and these are holding up fairly well. When you look at the NYSE common stock, above the moving average and going up, the S&P is looking pretty good, the mid caps are looking good, and the small caps are looking good. Then we look at a cumulative measure of NYSE of the advanced decline line based on price, and this really shot up on Friday and has been going up and is above the moving average. That's positive. Also, when we look at the regular NYSE advanced decline line, we were up and we're above the moving average, but we haven't broken out above this previous high, at least yet. Here's another measure of the NYSE advanced decline line, also positive above the moving average, but still has not broken out above this previous high yet. We look at common stock based on the NYSE on price. We haven't come back to this previous high yet, and we still have quite a ways to go here when we look at this based on volume. That is a little bit of a warning sign to us, but there's a positive side and a negative side to this chart. The positive side is that they're both going up. The negative side is we're seeing the divergence between price and volume. We look at the S&P McClellan oscillator. We actually dropped below zero. Now, on Friday's session, we were able to get back above it, so that's positive. And so when we look at the summation index, and if we go back to the McClellan oscillator, when we're above zero, that's positive for the summation index. When we're below zero, that's negative for the summation index. So when we look at this based on price, we were starting to roll over, but then we turned and went back up. That is positive. But we're seeing a pretty hefty negative divergence here. Looking at volume, this continues to decline. So we have price going up as volume is going down. Is that because of rotation that's going on, or is this telling us there's underlying weakness inside the S&P? We have to watch this play out day by day by day to try to figure out that answer. Also, when we look at the broad market, we dropped below zero on Thursday with the NYSE McClellan oscillator. In Friday's session, we came back above it, so it's turning back positive. So we're still going up, but kind of slowing down here with the summation index for the NYSE based on price and volume, where it's not as pronounced any kind of negative divergence between price and volume here. We're seeing that more in the S&P itself. Small caps, that's what everybody's talking about. We're wondering, is it for real this time? Because a lot of folks got faked out. We really shot up from the October lows right to the end of 2023. And everyone's like, okay, here we go, looking fine, looking dandy. And then we got into 2024 and boom, we were range bound. Well, we've finally been able to break above this range, but we're kind of in a shorter term range right now. We have not surpassed this intraday high that was set a few sessions ago. We're wondering, is this going to continue to go up and have the small caps look even more positive? Now, the small caps do better when interest rates are declining because these are smaller companies and they are victim to higher interest rates more than larger companies because they have to borrow a lot of money and it really bites into their earnings. If interest rates are going to start to go down, now it's probably looking like they're not going to be lowered at the July 31st meeting by the Fed that's coming up this week. The market is really pricing in some kind of a cut on September 18th. That's when the Fed will meet next. And the market is trying to front run that right now, trying to get this going before that even happens. The caveat of that, or the warning, is what if that doesn't happen? What if there's some kind of event that really makes things not show that we're going to see interest rates cut in the middle of September? We don't know that yet. The Fed hasn't actually come out and cut rates. There's going to be a lot of listening to what the Fed says when they make their announcement on Wednesday, and then the press conference after that. They're going to try to read into it what Chairperson Powell is saying, and then the market is probably going to react to that, even though there's not likely, in fact, there's almost no probability that there's going to be a rate cut on Wednesday. Then we look at another small cap index, the Russell 2000 small caps. This is looking positive as well, but still has not broken out above this previous intraday high here. But we're looking good when we look at the chart. We're above 50 and going up with the RSI. We're above the 50-period moving average. The 50-period moving average is above the 200-period moving average, and the momentum continues to be positive here. So this is still looking pretty solid. Now we look at a ratio between the small caps and the S&P 500. And I haven't shown this for a while because I was just saying the same thing over and over and over again, where if you do the ratio, small caps are still really underperforming. And they've got a lot of work to do still to go up and have this ratio switch from negative to positive. But they are improving for right now. So that's why I included it on the positive side, because the trend of this seems to be that they are improving. But if we start to see some weakness here, that could really shut down the small caps and really turn this ratio back down. Now, another area that we've been looking at, and I've had this chart for a long time, I just haven't seen the need to really show it, is the small caps are kind of the darling du jour right now. Well, for most of 2023 and into 2024, it's been the tech sector. And so let's do a ratio between them where we measure small caps against the tech sector. When this is going down, that means small caps are underperforming, and they still are. Well, we're starting to see this bounce, but not enough of a bounce yet to see this ratio actually turn from negative to positive. Doesn't mean that's not going to happen. That's a double negative. This could happen here, but we need to see more follow through. We need to see this ratio turn from negative to positive. Then we can have more confidence that small caps will continue to outperform the tech sector. Yeah, we look at the mid caps, which are not really breaking out themselves, but they're holding up a lot better above their 50-day moving average. And then we look at the equal weight, which is starting to outperform the weighted S&P 500 when the red line is above the bar chart here, even though they're on different scales from each other. Here's another way to measure that. When this is going down, that means the equal weight is outperforming the S&P 500. And then we're looking at the total US stock ETF, where we're coming off of setting a recent all-time high. We're still using the 50-day moving average as support here. And so far, we've been able to stay above that. This is about as broad as you can get for a measurement of the stock market. So this is still hanging in there positive. The financial sector has been quite strong lately, not setting new highs now with the sector, but well above their 50-day moving average and in a pretty solid uptrend. Then we do regional banks, which have been a real concern because you remember Silicon Valley Bank, Republic Bank, and then earlier this year, New York Community Bank. Those are all regional banks. And that's why this ratio was just diving around the way it has been. Well, we're seeing some improvement here. These smaller banks need to have interest rates lower. They've been counting on that in 2024. They have a lot of things that they're going to be refinancing and a lot of loans that they've given out that are going to need to be refinanced. And if interest rates are not cut, this could really hurt the regional banks. And so in anticipation of that happening, we're seeing an improvement here when we look at the regional banks compared to the financial sector. Now, as I just showed you, the financial sector is doing really well. It's the regional sector that hasn't been performing quite as good, but it is looking better right now. Here's the bank ETF, really looking solid at this point. And then we look at the financials and compare them to the S&P 500, still in a downtrend. See, we had a death cross here not too long ago, but we're really bouncing up. We're going to need to see this continue to go up and eventually see this ratio go from being a downtrend to an uptrend by showing us a golden cross and then continue to go up. If that happens, that's likely to give support to the S&P. Transportation stocks been another real area of disappointment in 2024. As this has been going down, that means the transports are underperforming the S&P. But we're seeing a bounce here. If this can continue and start to really go up, that could also help the broader market. And we look at the yield on the 10-year, which we were going back up and then we dropped down just a little bit. What I'm looking at here is we're seeing a death cross, and that's positive. That means that the trend for the 10-year yield is actually starting to go down on a trending basis. If this can continue to fall, that will give more support to stocks and also feed into the scenario that the Fed is likely to cut rates in the middle of September. Then we look at a ratio between the S&P and 3 to 7 year bonds, and it's been seeing some weakness so far. But for the most part, we're still going up. And when we can kind of interpret what this is meaning to the market, when this is going up, that means the market is anticipating a soft landing, meaning that we have seen economic weakness, that the Fed's probably going to come in and cut rates soon, maybe in September. At least that's what the market thinks. But it's not necessarily for economic reasons. They're not cutting rates because of some black swan event, because things are falling apart. They're cutting rates because we're getting closer to that 2% target for inflation that they wanted to get to, as inflation has been coming down. And so the market is anticipating that we're going to see a soft landing, which means even though we've seen this economic weakness, it hasn't led to a recession. And about once a month on the website, I do a video now where I go through. These are the charts that we're looking at that say we're going to go into a recession. These are the other charts that we look at that say we're not going to go into a recession. And right now, when you look at this chart, the market, even though it's pulling back, if this can turn and go back up, that means the market will be more convinced that there'll be a soft landing. If this really starts to fall and we drop out of the rainbow and then the rainbow starts to roll over, that means we're possibly heading towards a hard landing. Then we look at a long-term chart of the NASDAQ 100. We've come down to this trend line going back to 2009. Is this going to provide some kind of support, or are we going to fall through it? No, there's been other times, because I connected it from 2009, then there's a couple of lows here, and then I just let it run forward from there. We have fallen below this before, and it wasn't necessarily the end of the world, but this has been positive as we're above it. It's going to be slightly more negative if we end up dropping below it. Now, this is a chart that the perma bears are just salivating over, because we hit a real high in this ratio when we measured the NASDAQ 100 against the Dow. This is the dot-com boom and then the dot-com bust, and we set a real high value. Then it took us many, 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 many years to get back to this same level, and this was the end of 2021 when everything shifted into 2022 and the market was negative and we started to go down. Well, I haven't really seen the perma bears talking about this. Doesn't mean they haven't. I just haven't seen it, where we started to go above this red line and set a new high with this ratio. Oh, that didn't really fit into their plans. They thought we were going to come up to this ratio high again and then just tank from there. Well, we are coming down, but think of the context of this chart. Okay, when this is going up, that means the NASDAQ 100 is outperforming the Dow. If this is going down, that means the NASDAQ 100 is underperforming the Dow, which is not necessarily a bad thing, but it's not necessarily a good thing either. So there's some other charts that we want to look at. And one of my complaints with the perma bears is that they look at this one chart and they make all their conclusions based just on this. And I think that's silly. I mean, it's like, look at the context of what's really going on here. So we look at some other things. We look at the QQQs, which is the NASDAQ 100, and compare it with the small caps. They're the ones that are really doing well right now. And we were going up, meaning that the QQQs or NASDAQ 100 were outperforming the small caps. And we're seeing that pulling back right now. Is that necessarily a bad thing? The market can still go up with small caps doing really well. Look at what happened here in 2021. This was going up and the market was going screaming higher, and the Qs were also going higher and small caps were going higher at the same time. So that's not necessarily a bad thing to have this dropping off. We need to watch this as it's unfolding and then try to evaluate things day by day to see, are things shifting more defensive where we're getting ready for a decline, to taking money out of one part of the market and now seeing better returns in other parts of the market? Is that what's going on here? And that's what it appears to be as of right now. But we need to watch this as it unfolds to see if that still continues. And we look at semiconductors, a massively huge part of the tech sector, and compare it with the Dow. This ratio is also coming down. We came up to this high that was set back in 2000. We actually went up and set a new high with this ratio, and it's been declining. Okay, so does it mean everything's going to fall apart? To the perma bears, yeah, they've already declared the end of the stock market. But look at the context. The semiconductors have been under pressure. But where's a lot of the earnings coming in? Where is a lot of the growth coming from? It's the semiconductors. So are they eventually going to find bottom and start to go back up? That looks quite likely. The Dow's been doing quite well lately because it had a couple earnings reports that came out. And there's only 30 stocks in the Dow. And the Dow's been actually lagging for the last month or so. It's just been in the last week or so that the Dow's actually been performing quite well. Then this is actually quite positive. We look at home construction and we compare it to 3 to 7 year bonds. Now, if interest rates were getting ready to go up and up and up and up and up, do you think this ratio would be going up and up and up and up like it is? No, we're setting new highs with this ratio. This is very interest rate sensitive. If interest rates were going to keep going up, this ratio would be going down. We came all the way down to this 250 period moving average, and I was pointing that out as it was happening. And since that time, we've seen a real shift in the market. We bounced up here. We've seen this rotation out of mega caps into small caps and mid caps, and this keeps going up, and that tends to be more positive for the economy. Now we look at the negative side. Yes, yes, yes. All right, we are now negative as far as sentiment is concerned because we're below 50. We had been above 50 and we're going up, and then we had some down days and we dropped below 50, even though we ticked back up slightly on Friday. We're still more neutral right now, but when my line in the sand is when we're above 50, that's positive. And especially if we're going up, and if we're below 50 and declining, that's negative. And that's why I decided to put this on the negative side for right now. This is also negative, and this is my main indicator. And I say this ever so often. If somebody said I could only have one chart, what would it be? It would be this chart. This is the ADX, known as the average directional movement, because we get a lot of information from this chart. The main focus of this chart is the dark black line here. When this is going up, that means whatever the trend is, it's getting stronger. When this is going down, whatever the trend is, it means it's getting weaker. I plot a moving average on here just to give it a little bit of context, and I can see these crossovers. Well, we are in a weakening trending environment. Now we get some additional things from this chart. We see where the red line is above the green line now. That's a switch from when I did this video a week ago. That means we're negative right now, but the red line is declining. However, the green line, which is on bottom, is also declining. So this is actually turning more negative for right now. Whatever line is on top, that's what we default to. So in the intermediate term, according to this chart, we are now in a negative trend, but it's a weakening trend because the ADX is below the moving average and it's going down. So we'll just watch this unfold day by day and see if this shifts even to looking more negative or to trying to turn back more positive. This is also negative because the VIX is going up. Even though we came down in Friday's session, we have been getting very, very low closing readings. That's the line chart for the VIX. And then it really started to shoot up. And on the bar chart, it's really been going up as well, even though we closed near the low for the session. But this just means that fear is increasing, and when this goes up, that typically means the S&P is going down. We also look at the VIX of the VIX. This is like an indicator of the VIX. When this is going up, that means that volatility has been increasing. Typically on down days, the VIX of the VIX will go up. On up days, the VIX of the VIX will go down. But this is still a lot higher readings than what we've been seeing. Then this is a study put out by Tom Bowley, who's with stockcharts.com. He's also with another site called earningsbeats.com. He put out this in late 2023 with the numbers that you see here. I just updated this as of Friday's close. This is a weekly chart of the VIX. And when we get very, very low readings with the VIX, that's when we get the best annualized returns. Well, we closed at 16.39. We're right up into this lighter green area here. And so the returns are still positive, but they drop off quite a bit. Now, if the VIX starts to really go up, we still get positive returns until we get above 20 with the VIX. That's when we start to see negative annualized returns. So we just want to keep an eye on this as the VIX has been going up. We're also seeing that as measured by the MACD, the momentum of the VIX is up right now. And this is another smart money indicator. And I use this in two other charts and I put them together and I call them my smart money charts. This is accumulation distribution. This measures not only the direction of price, but it also measures volume. And this is where we try to see what is the smart money doing, because that's what we want to be doing. And when we're above the moving average and it's going up, that's positive. Well, we've dropped below the moving average now. Then I added this other indicator here called the boom indicator. And when we drop below the center line, that means we've crossed below the moving average. And now we actually got to the point where we're seeing an extreme negative reading, and we bounced up from that in Friday's session. So maybe a little bit of a bounce. But when you take all of this together, the fact that we're still below the red line is negative. And this is a smart money indicator. Another smart money indicator, chart number 2, is the Chaikin money flow. we have dropped negative, and the red line, the moving average, continues to decline. So now we have 2 out of 2 charts that are still negative. And the Chaikin oscillator is negative, but it's extreme negative. We might see some kind of a bounce from here. We haven't seen one yet, but it is getting to a pretty extreme reading at this point. But for right now, it's also considered to be negative. So our 3 smart money charts are still negative. Then we look at the vortex. And this had been positive for quite a while. Well, this past week, we saw the red line cross above the green line. That means this chart has now turned negative also. This is another primary indicator that I use. Another primary indicator is the parabolic SAR. Now, there's really no in-between with this chart. It's either positive or negative. When the dots are underneath, that's positive. When the dots are on top, that's negative. Well, we still have the dots on top, so that's negative. And then this was positive for many, many weeks. Now it's switched a little bit more negative, where this is a weekly chart of the S&P, and we were able to get above this R2 level. We dropped down below it. But wouldn't you know, we closed at 54.59, and the level of this line is 54.51, like a 1.5. We're below this. So we're pretty much right on this line for the time being. Are we going to fall down below this, or are we going to be able to bounce up off of that? Then we look at some intraday charts. Large cap growth versus large cap value. The red line's on top, the blue line's on the bottom. That means value is outperforming growth. In more solid environments, like we saw in June, the blue line is on top, and that's usually when the S&P really starts to go higher. And we're looking at S&P growth to value. Since the earlier part of July, this ratio has more or less been going down, and that is why it's weighing more on the S&P 500. But look at the small caps. Small caps could be breaking out, but their growth to value ratio is not. It's actually going down. Mid caps looking a lot better, but their growth to value ratio is going down. S&P growth to value on an end of day basis here, going down as the ratio has also been going down. When we look at growth, that's buy low, sell high. And that's what most people want to do with stocks. Where value, that's where folks get into these when they're afraid the market is turning more defensive. And we're seeing value really improving lately. And we're not sure because of that's rotation, or is the market actually setting itself up to be more defensive? And we've been watching that, or I've been watching that for the last few weeks now, and even mentioning it in the daily videos. And we continue to watch that now. This is another measure, a growth ETF versus a value ETF. The growth ETF had really been outperforming. Now it's starting to come down, and we're inside of the rainbow. Another area, it's kind of like growth versus value, is discretionary versus staples. The things that make life fun, like, things like Tesla, Amazon, they're in discretionary. Staples, this is toilet paper, toothpaste. Well, this ratio is going down. In a more positive environment, we want to see this ratio going up. In our growth to value ratios, when we look at the Qs to S&P, down. Discretionary to S&P, down. Large cap growth to large cap value, down. In a more positive environment, we want to see these ratios going up. And we look at the large caps are going down, mid caps are going down, and even though the small caps are improving, it's going down too. This is a warning sign to us. Then we look at the state of the 20-period moving average as measured by the double and triple exponential moving averages. We dropped below that, and the lines are going down. That's why in the short term, we're now negative, because these lines are declining and prices below both of the lines. We're also negative because we're below the regular 20-period moving averages. And I plot a simple and exponential moving average on here. So that's why the short-term trend is still negative. And we're also maybe a little too negative. This is another version of the boom indicator. And this is what I originally created this for. This measures how far away is price from a 20, 50, and 200-day moving average. When we get too far away, it acts like a magnet or a rubber band and tends to boom price back to the moving average. Well, we've got down to an extreme reading here, and we're getting kind of far away from that 20-period moving average. So that in the short term could give some support to the S&P for going up. We're turning more negative now when we measure the distance away from the 50. We're dropping below zero. In fact, we're right about on zero currently. We're still positive when we look at the 200-day moving average. Even though we're declining, we're still above zero. All right, then we look at the state of the 50-period moving average, looking at the double and triple exponential versions here, where we're below these lines, and the red line is starting to drop below the green line. The red line goes faster. And so if this comes down below the blue line, that means the that the triple is going faster than the double, and that means the intermediate term trend could be picking up some steam to the downside, as measured by this chart. Then we look at the momentum. All right, and we're negative across the board. Here's short term. I have 3 intermediate term oscillators and then 2 long-term oscillators. They're all going down right now. We look at a thing called the Ichimoku cloud. Sometimes I call it the itchy and scratchy cloud, where this is not necessarily negative in and of itself. There's a couple of different ways to use this. And all this is a set of moving averages that are plotted against price and then shifted forward. And a lot of folks that trade in the Forex markets, they really rely on this. And it can be kind of helpful. Not so much because it tells us anything we don't know. It's because so many people use it. This ends up being kind of a self-fulfilling prophecy. We're still above this green cloud. And one way of using this is when we come inside the cloud, somewhere in the cloud, as long as it's still green, that will often provide support. When we come into a cloud and it's red, that could be turning things more negative. Not always, but kind of a general rule. What I'm picking out here is that we're seeing this green line back here continue to decline, and we're seeing the blue line start to drop below the red line. That's turning this a little bit more negative. But we're still positive since we haven't even come down into the cloud yet. So there's a positive and negative side here. Then we look at the S&P to utilities ratio. When this is going up, that helps the S&P. When this is going down, that hurts the S&P. And for the last few sessions, this has been going down as utilities have been outperforming the S&P. Well, look at the FANG index. Facebook, Apple, Amazon, Netflix, Google, NVIDIA's in there too. We're still below the 50-day moving average here, but we're in a longer-term uptrend. The NASDAQ, below its 50-day moving average for right now, but the trend is still positive. The NASDAQ 100 came down to this pivot point and bounced off of that. Is that going to matter? But we're still below the 50-day moving average, even though we are in an uptrend here. And we look at the NASDAQ 100 bullish percent index, where it was positive for the S&P and positive for the NYSE. It's negative and declining for the NASDAQ 100. That's a concern to us. The momentum for the NASDAQ 100 as measured by the PPO is declining and declining kind of severely. And we fell below the 20-period moving average when looking at the QQQs. This is the ETF that applies to the NASDAQ 100. And we're dropping below the 50-period moving average. Didn't even try to provide any support. Now, earlier on, when we saw a decline, these moving averages will quite often provide some kind of support and will bounce right up off of that. This time, that didn't happen. Now, it looks like the S&P, which has more value in it, where the QQQs have more growth in it, it looks like maybe the S&P is going to be the line in the sand. And that's why the market's right at that 50-period moving average with the S&P, where we've already dropped below it here when we look at the QQQs. And here's a weekly chart. And I pointed this out a few weeks ago. It looked kind of scary where we open and close right here at the top. That's more of a doji, if you know candlestick lingo. And then this is usually kind of a negative sign. It means a lot of indecisiveness and a potential reversal where we open, go up, we have a low, and then we close right about where we opened. Well, then we've been declining for the few weeks after that. This is a weekly chart, and that is more negative just looking at these bars by themselves. Then we look at the Staples to S&P 500 ratio, and this is going down. That's positive for the S&P. Well, now this is going up, and so that's more negative for the S&P. We look at the Staples to Tech ratio. Overall, Tech has been outperforming, and that's what happens when this ratio is going down. But lately, we've been bouncing back up. Are we going to get above this 200-day moving average? Are we going to turn and actually start to go up? That would be more of a telltale sign that the market's becoming more defensive. Because right now, it's like, okay, Tech is saying, I'm willing to give back some of my gains. I've got a lot of gains for 2024. But at some point, I'm going to say enough's enough, and people are going to come in and start buying Tech, and that could put this ratio headed back down. Well, if that doesn't happen, that means that the staples are starting to outperform Tech. And if we see a crossover with these moving averages, that means the market climate could end up changing. We don't know right now. We can guess, we can speculate, we can have opinions galore. We have to watch the charts to see how this plays out. We'll look at large cap growth. This has been a real big area in 2024 and even going back into 2023. We're seeing some weakness here. We dropped below the 50-period moving average. We're still above the 100-period moving average. We look at the ratio between the large caps and the small caps. When this is going up, that means the large caps are really outperforming. But lately, we've seen this ratio really going down as the small caps have been underperforming. Now, this could have been up on the positive side because small caps are doing better. But since I focus on the S&P 500, and that's a large cap index, the fact that this is going down, that's why it's on the negative side. And we look at the dollar, which is still in an uptrend. We did see a little bit of weakness this week, and that did give some support to stocks. If the dollar really starts screaming back to the upside, which could happen, but most likely won't if we're going to see interest rates going down. Think about this. If you have to pay more interest for each dollar, if interest rates are going up, doesn't that make each dollar worth more? Yes. The dollar tends to go up in a rising interest rate environment, and it tends to fall in a lower interest rate environment. And so if we're going down, we might see some more weakness in the dollar and actually turn this to a downtrend, and that would be more positive for stocks. But in the meantime, it's still in an uptrend. All right, now we have this crazy thing called the Hindenburg-Ullman. And go back here and read this if you want to check out. These are all the rules. But what I have here is a chart that takes all those rules and puts them into one chart here. And we had the initial signal from a Hindenburg-Ullman based on the NYSE that applies to the S&P 500 that was triggered on July 9th. Now, to make this a valid signal, and of course the perma bears, they're saying, oh, we've already got a Hindenburg-Ullman. No, we don't. It has to have a confirmation signal. We have to have 2 spikes by August 2nd. Now, that's this Friday. So we need to see another spike up here sometime in the 5 trading days. Now, one thing to be aware of, this is Thursday's close. We get this 1 day late when it's updated. So we don't know Friday's number yet. But if we see another spike on or before August 2nd, that's going to mean a confirmation signal. And look what happened other times we had a confirmation signal here. We had a pretty severe decline back in 2019. This is the COVID crash right here. And this was the big top that we set before we went into 2022. So yeah, we might want to pay attention to this if we get a confirmation signal. But until we get a confirmation signal, don't listen to any of the perma bears. There is not a confirmation yet, according to the chart that I'm looking at. Just to give you another idea, here's the NASDAQ Hindenburg-Ullman. It had all kinds of confirmations here, and the NASDAQ just kept going up. So it doesn't mean that this is infallible. There's no perfect indicator, and this is not one of them, even close. It actually has a pretty low percentage, but the last few times, at least for the S&P, that this has been triggered, it's been helpful. But it's been triggering left and right here for the NASDAQ, and it's been completely wrong. Okay, so thank you. I really hope you found this helpful. Please feel free to tune in to the daily videos where I go through these charts. I'm looking through the bonds versus stocks and all that stuff. Have a great weekend, and I will talk to you in the next video.